Hi, everybody. I left my puppets at home. I apologize.
Scott, we were pretty excited when I found out that we were going to have an international guest. And I was thinking big city lights, New York, and then I found out you were from New Zealand.
Is that okay to admit? Yeah, I was actually born in Wellington. My father's a New Zealander and my mother's an American. So,
well, welcome. We're
Thank
delighted
you.
to have
Thanks
you
for
this
having
afternoon. I know I had to do some reading when I first knew that you were going to be coming to speak with us today, and I think there'll be some people in the room here today that may not know the full extent of what KKR does and what you do and how you invest. So I thought maybe just as a starting point, you can just tell us a little bit about the full extent of what you do and how KKR thinks.
Great. Thank you, James. Well, just very high level. So we focus on the alternative asset management space. And today we manage a bit over $200 billion of third-party capital. And if you break that down, I think we're best known globally for our private equity business. That's about 75 billion of the 200. But we also are very large in global credit. So we manage about $70 billion in credit today, so nearly as much in credit as we manage in private equity. And the rest of the firm's activities are largely around real assets, so think infrastructure, real estate equity, and real estate credit, and then energy and hedge funds. So we're really pretty broadly based across all of alternatives, focused largely on the more private markets end of the spectrum. It's something we can talk about. We're finding that today we are getting significant compensation for taking illiquidity, and we've really been building the firm in that direction. One of the things that's a bit different about us is that we're our own largest investor. So we're a third-party asset manager, but we also have a large balance sheet as a firm. So the firm itself, we have about a $20 billion balance sheet, which makes us our own largest investor in virtually everything that we do. So we're big believers in alignment. And we also, ever since the firm was founded in 1976, we've always run the firm with a one-firm culture. So everyone around the world, and we now have 20 offices around the world and about 1,300 people, everyone participates in the same P&L globally. So ideas travel, relationships travel, and everybody's motivated to help each other. So that's a little bit of the high level about us today.
Well, let's stay high level. You've just heard the concluding remarks on the debate, and I think that is a question that people are thinking about. What's your take? Because the cycle, I heard an interview that you did last year, and you and Joseph both agreed that you felt like it was late cycle, but there's no doubt people have been surprised that the cycle has been prolonged. So I'd be interested to get an updated view on that and some of the things that support your views.
Sure. I'd say it is very hard. I mean, and usually when you talk about markets, there's a necessity to talk about the averages and kind of how the markets as a whole trade, which means you're discussing things at a 50,000-foot kind of level. What we're finding is that it's just not nearly that simple. This feels to us, it's very much a have-nots market. So what we see around the world, if a story is simple and a security is liquid, it is extremely well bid, and it is very hard to get excited about investing. However, if there's some complexity to a story or there's illiquidity involved, we find that there's often excess return. And so largely what we're doing, if you really boil it down, is we're buying complexity and we're selling simplicity. And I think the market, to some extent, does have post-traumatic stress disorder. The crisis was the formative experience for most people in the world allocating capital. And so I think what we're seeing in the market now is that when you have some negative news that comes out, there's a tendency to sell on the news, almost in the vein of, oh my goodness, it's happening again. And then there's a view that seems to kick in as I missed a trade of a lifetime back in 2009, so maybe I should get back in. So we have these bouts of volatility. And so we're really focused on two things. One is monetizing that volatility when it shows up and investing kind of when we see that downturn and taking advantage of dispersion. And the other thing we're focused on is really monetizing this market fear of illiquidity or perceived illiquidity. And so as we go around the world, there's some markets where we're net sellers, and there's some where we're net buyers. And really, it kind of depends on those two themes and how they're playing out in each market and each underlying asset class.
Well, we'll get into some more specifics along the way, but the liquidity piece was something you've touched on a couple of times already now, and I know it's something, it was raised in the debate. How do you reconcile being able to get your money back from a liquidity perspective? And you talked about wanting to be compensated for that lack of liquidity. Can you give us a bit of a sense of how you think about liquidity and the pros and cons as you weigh it up from an investment perspective?
Sure. Look, I think the important thing to understand from our standpoints is that what we went through in terms of the crisis was really a largely liquidity-driven crisis. Those don't happen that often. I actually think it will be healthy for the global markets to go through a more normal recession at some point. And just remind all of us that most recessions and most economic cycles do not have that element of liquidity drying up, because there's a significant amount of capital in the world today. And as we look around and try to figure out where do we expect there to be dislocation, we don't see a lot of areas that are lacking liquidity. We as a firm, frankly, are hoping for it to some extent. Today, we sit on well over $50 billion of dry powder. We're managing our own balance sheet with record level of cash because we're ready to invest when dislocation shows up, and we've seen these bouts, Q1 2016, Q4 2018, but they tend to be very short-lived. And so there's a lot of capital in the world today, and there's a lot of liquidity in the world today. And we can come up with scenarios, nodes on the tree, where we say, if this, and this happens, we could see liquidity dry up, and we could see more anxious selling in the markets. But the vast majority of the probabilities, we think you're less likely to see a liquidity-driven economic cycle. And honestly, I think we could argue, even though in the US, as an example, we're now in the longest expansion in history, that is, again, top of the waves, right? It's a little bit like a duck swimming. It all looks okay above the water. There's a lot going on below the surface. I think we could argue in the US in particular, we've seen a number of different industries go through their own mini recessions. Industrials, energy, retail. We're starting to see some pullback in parts of healthcare. So, there's a lot happening. The consumer and the services markets have been strong. And that's why the overall picture is a good picture. But there's a lot happening beneath the waves.
Well, let's get into a few specifics. You've talked that you're sitting on a lot of cash, $200 billion. There's also a lot invested. What are some of the exciting opportunities that you're seeing out there? What does pique interest in KKR, and what are some of the things that you're watching or that you're monitoring closely from an to invest in?
Well, I think a lot of what we're seeing is really around this theme around complexity. And what the market is doing is motivating companies to be simple and be straightforward with their stories. So one of the big themes that we're seeing right now is that companies are selling non-core subsidiaries. Because if a company is public and they have a lot of explaining to do in any given quarter, or there's a series of different entities underneath their company that can create some volatility, they want to simplify. And so they're selling non-core subs. So we've been particularly busy all around the world buying non-core subsidiaries from corporates, both public and private. We've been particularly busy in Japan, as an example, over the course of the last 5 years or so. But it really is a global phenomenon. We've seen it US, Europe, and Asia. And we think that is going to continue. Activists, frankly, also create that kind of deal flow because they'll get involved with a company and motivate a board or a management team to want to sell non-core subsidiaries, and we can be acquirers of those subs. Another thing that we've seen is globally, the banks have really pulled back from a lot of their former lending activities. And even though we're 10 years post-crisis, we're still seeing very large opportunities in the private debt market because there's large parts of the middle market economy, US, Europe, that frankly the banks are not lending to anymore. And so private capital like ours is moving into that space, and we're able to get paid an illiquidity premium and get real structural protections, real security, and real structural protections for doing that lending and able to capture an incremental return for our investors. And the third thing I'd point to is readiness. I mentioned that the market's having these little bouts of emotional dislocation. And so we're very focused as a firm on being ready, so when the market trades down, we can move in, which we do through more of our liquid credit business around high yield and leveraged loans around the world.
Mm-hmm. What about some of the sort of the bigger investment bucket opportunities? I was reading an article this morning. Macquarie Bank, which is one of the big investment banks here in Australia, have had a great 2 decades investing in infrastructure, and they've just talked about wanting to now get into supporting renewables and energy on that front. Do you look at some of those sort of longer term style investments, and do you have a view on where some opportunities might lie on that front with some of those sorts of areas like renewables and that sort of business?
We do. We have a active and growing infrastructure business, which we started again around 2010, and we're very active globally in infrastructure, and we've done quite a bit in renewables actually. In that space. We tend to define infrastructure more on the stable, contracted, recurring cash flow end of the spectrum. And so we found that there's plenty to do. We've actually been most active in Europe on the whole. But we have invested in wind, we've invested in solar, and we find that there's opportunities on a global basis in that space to get long-term contracted cash flows with some equity upside.
Interesting. In terms of the valuations that are around at the moment, you've talked about wanting to be able to be nimble. I had a look before our chat at what's been happening with some of the big name US IPOs that have come to the market recently. Uber, Lyft have not performed particularly well. As we chat, WeWork is being repriced. What are you seeing from a valuation perspective in terms of differentials between what's available in private markets and what's available in public markets?
Yeah, so it's a great question. So first thing I'd say is back to this point of that averages can be dangerous. A lot of the growth in earnings globally has come from tech. If you take tech out, we really haven't had that much earnings growth on a global basis. What we find in a recurring theme is that management teams are finding it's not that fun to be public. Because especially in a market like this, if you miss your earnings just a little bit, you can be meaningfully penalized by the public markets. And we can see, entire companies just get given up on by their public investors. So back to this bifurcated market, the haves, and it's been a lot of tech until recently, have been able to do no wrong. The have-nots can kind of do no right. And so we spent a lot of our time with those sectors because, a fast-growing tech company is probably not where we're going to spend most of our time. We're spending time with the have-nots that are really liking the ability to be private and do the right thing for the very long term. Because I think the public markets globally have become very focused on meeting the quarterly earnings. And there's been this move to guidance, and God forbid you miss your guidance, because then you get seriously penalized. And that creates a dynamic where CEOs and management teams say, boy, wouldn't it be nice to be private for a while and do what I think is right for the very long term. And so we've been able to benefit from that dynamic. But you've seen a lot written lately on the number of public companies declining, and actually just the aggregate number being lower than it's been. And I think what we're seeing is that trend will continue to play out, and now to some extent it's extending to tech, where there's really kind of gone this question of everybody was going straight up, and now there's a question, is it really worth what people have been valuing things at in the private basis? And there's a lot of private companies that as they kind of emerge to public, will get some real price discovery. But there really hasn't been true price discovery on a broad market basis for most of those companies yet.
In terms of the private markets themselves, one of the things that we hear has caught some press down here is that private equity is sitting on a big war chest. There's been a lot of new firms raising new funds. How competitive is it for you to get deals and attractive deals these days?
Look, it's a competitive market on a global basis, and so you need to have an ability to make companies better. I think what we do, especially in the private equity end of the spectrum, probably isn't as well understood as it could be, and that's on us. You cannot just buy a company, put leverage on it, and hope things go well. Financial engineering is not how you can generate returns. It just doesn't work. The markets are too transparent, and frankly, the leverage markets, everybody can get the same terms now. And so you need to have a way to make these companies better and work with management to materially improve them operationally. And so when we have an angle like that, when we think we have something special we can bring to bear, then we have an opportunity to really be more competitive, and those are the deals that we tend to prevail on. But if we don't have that angle, if we don't have an ability to bring operational improvement or maybe acquire a company through one of our portfolio companies and act like a strategic, then we'll often get outbid. But if you got to keep in mind, I think private equity gets far more media attention than we're due, given our actual relevance in the world. Usually somewhere between 5 to 15% of global M&A activity in a year comes from private equity. And so it's just not that much. We don't have to find that many interesting things to do in a year to be able to deploy capital and do our job for the people that are counting on us. So again, been in business 43 years, just over 400 investments in private equity in 43 years. So if you put that per year, that's not that many transactions. So it's competitive, but it's all about, is it a theme we like? Is it a situation we can really add value? And is it something that we're convicted that we want to own for an extended period of time?
Mm-hmm. You've talked about a few things that you do want to own. What don't you want to own? What are some of the things that look ugly or that just look ridiculously expensive?
I'm not sure I'd use the word ugly, but there's things that we are probably more cautious about right now. One of them would be just as a follow-up to my comment that a lot of the growth in the world has been from technology. Over the course of this past cycle, I think on the margin, that's not something that's likely sustainable for the long term. So while we're doing things in technology, it tends to be in areas that are more fundamental underlying systems based as opposed to anything on the new technology front where you're hoping. So we're not a venture capital firm. We're not spending as much time in tech maybe as we would have at the beginning of the cycle. So tech would be one thing that would be probably on the margin more cautious about. The other thing that we're worried about, and this is one of these nodes on the tree that I mentioned that could create a little bit of angst, is the investment grade debt market globally has expanded materially. And if you think, I'm thinking at the lower bounds of investment grade, so think triple B type area, where there's been significant issuance of debt, corporate debt on a global basis. And in the credit markets, if there is some kind of economic cycle and some hiccups, and those triple B names get downgraded to double B, there is going to be, we think, a significant fall in price of those securities. Because the amount of capital formed in the world around investment grade debt relative to non-investment grade is a significant difference. And so we're watching that. So that kind of lower bounds of investment grade debt would be something that we'd be watching closely and not as focused on putting capital to work there. Because I think everybody, what they've done is they've focused on moving to perceived quality, but the yearn for yield is everywhere. So what they want is they want the quality of investment grade, but they want a little bit more yield, so they'll talk themselves down into triple B. But if that gets downgraded in a recession, then there's fewer buyers on the other side. So that price gap risk could be material. Mm-hmm. And then the last thing I'd mention that we're just watching is these ETFs on a global basis, especially around leveraged loans and high-yield bonds. And this has been particularly the case over the course of the last decade. There's been a significant amount of capital raised in ETF format where the underlying retail investor is expecting their capital back on a daily basis. The underlying securities that those structures own, the markets are really not daily liquidity markets. And so there's been a lot of capital inflow into those entities, but there hasn't been a lot of taken out. And one of the things we're watching is if you see a significant amount of redemption from that loan and bond ETF world, it's a question as to what happens with the underlying and how can they actually satisfy those redemptions. That'd be another node on that tree. Again, low probability, but something we're watching and something that we would avoid.
Final question. You've come down, you have a much different perspective from New York City. We're down here in Sydney. What do you think if you were to put yourself in the shoes of an Australian investor, from our perspective, where do you see some of the big opportunities from down here?
Yeah, look, we're really excited about the Australian market. We have an office in Sydney, have had for, since 2007, and have been very active. So we've deployed over $6 billion so far in Australia across private equity, real estate, and credit. And we're continuing to expand our team and our efforts in Australia. So we will be building out the team further and looking to expand further into areas like infrastructure, and really take all of KKR to Australia in an even bigger way going forward. I think we're going to need more office space. But we're exceedingly excited about what this market provides, and have had a lot of very nice investments here, are looking forward to continuing to partner with the business community. And we found everywhere we've gone in the world, we've been able to develop really nice relationships. I think one of the things we need to do a better job of as an industry is make sure that people understand what we do. Over the course of our firm's history, even in private equity, we tend to hold companies on a longer-term basis than most. Right? So on average, it's somewhere between 6 and 7 years. And we've got a number of companies that we've owned for well over a decade. And so for us, we're about providing, hopefully, intellectual capital as well as the capital itself to help companies solve problems. And that's really where we find we have the best relationships, is where we can work with the business community, help them solve problems that are difficult to solve, and in the process make businesses better, communities better, and do a great job for all the stakeholders that we're responsible to.
Great. Well, listen, thank you very much for taking some time to come and sit down with us here at Livewire Live 19, and we hope you have a great time while you're in Sydney.
Great. Thanks very much. Thanks, everybody.